Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll discuss where we are in the current market and economic cycle, why the underlying principles of long-term investing remain as relevant as ever, and what that means for your portfolio. It has now been more than 3.5 years since the current bull market began in October of 2022. At that time, inflation was rising at its fastest pace in 50 years. The Fed was hiking interest rates aggressively, and AI tools like ChatGPT hadn't even been released yet. But since then, the S&P 500 has more than doubled in value. Of course, the concerns never stopped coming, including geopolitical conflicts, a banking crisis, tariff volatility, and more. Each cycle brings new headlines that can make investors question whether the tried and true rules of investing still apply. So, over the next few minutes, we'll walk through why they still do. First, let's talk about what is often called the wall of worry. As this chart shows, going all the way back to World War II, bull markets have lasted far longer and generated much larger gains than what's lost during bear markets. A great example is the bull market that followed the 2008 financial crisis. It lasted nearly 11 years, and yet it's often called the most unloved bull market because there was always something to worry about. In hindsight, those concerns, while legitimate, didn't justify making dramatic changes to long-term portfolios. The historical record makes it clear that reacting to every market move has, more often than not, caused investors to miss much of the gains that eventually followed. Next, while the stock market and the economy aren't the same thing, they are closely connected. Corporate earnings can drive stock prices over the long run, and earnings ultimately depend on economic growth, so keeping an eye on the broader economic cycle matters. The last official recession was the brief but sharp downturn during the pandemic in 2020. Since then, there have been periods of slower growth and plenty of recession predictions, none of which have yet materialized. Today, the economy is healthy by many measures, though investors are keeping a close eye on a few areas. Specifically, the focus is on oil prices, the job market, and the scale of AI-related investments. Some wonder whether today's AI spending boom could be a, quote, bubble. That's an understandable concern given that many investors lived through both the dot-com bust and the housing crisis. Unlike some past periods, earnings growth has so far supported current valuations. And many of the companies making large AI investments are funding them from their own profits. The key for investors continues to be balancing different parts of the market to benefit from growth while managing risk. In 2022, when both stocks and bonds fell at the same time due to rapidly rising inflation and interest rates, some investors wondered whether bonds still served a purpose. The years since then have provided a clear answer. Bonds have recovered and once again deliver meaningful income and portfolio balance. International stocks and other asset classes have contributed as well. This pattern has repeated itself throughout history. Each time, staying diversified and focused on long-term principles proved to be the right approach. So, more than 3.5 years into this bull market, those principles remain as relevant as ever. We hope you found these insights helpful. If you would like to discuss the current market cycle and how your portfolio is positioned for the road ahead, please don't hesitate to reach out. We look forward to speaking with you.